Hi, Rich Davis here with an important financial alert, so please listen closely. Did you know that institutional and individual investment managers with over 100 million or more in assets under management are required to file with the SEC Form 13F? Why is this important to you? The reason is the 13F discloses recent changes in the amount and allocation of these managers' holdings, including their long and short positions. Long positions gauge the manager's future forecast, while short positions equally gauge their near-term predictions. The 13F, for example, is used by Warren Buffett as well as George Soros, two men that we can say with confidence have a pulse on both the global and domestic markets. Monitoring the trading activity of these two market makers is the closest you will come to forecasting their Billionaire Code. The mainstream media outlets remain overly optimistic with their conjecture. Please do not be fooled by their market propaganda, which conveniently neglects to mention very important shifts these billionaire investors made within their portfolios. The winds are changing. Billionaires are rapidly exiting the equity markets. Why? Because the current market bubbles show an eerily similar correlation to the value to price of tech companies traded on the NASDAQ right before their crash in May of 2000. I encourage you to read our daily reports or to inspect for yourself the residential mortgage lending origination numbers prior to the crash of 2008. The data speaks for itself. We are currently facing the perfect storm, a storm that correlates across the equity and bond markets. Are you prepared? According to recent 13F filings, Warren Buffett and George Soros are preparing for this financial tsunami and have made significant moves in their investment strategies. Not only are they preparing their portfolio to avoid the storm, they are positioning themselves to profit afterwards. Wouldn't you like to have the same advice? Despite the rosy picture painted by Wall Street analysts, Warren Buffett has dumped a number of stocks with exposure to American consumer goods. According to previous filings, Buffett's Berkshire Hathaway significantly reduced its exposure to consumer-related stocks like Procter & Gamble, Johnson & Johnson, and Kraft by 21%. Recent filings show that Buffett has remained underweight in U.S. consumer equities ever since. February's filings show that Soros has increased his put options against the S&P 500 by 154% in the third quarter of last year, a position that signals a strategic hedge. This bet against the S&P 500 has increased to 1.3 million, representing the fund's largest position. The equities markets is being boosted by quantitative easing, which has fueled record corporate buybacks. Recently, corporations in the Russell 3000, which include American Express, have bought back $567 billion worth of their own shares. This is a 21% increase in buybacks year over year. These buybacks artificially boost their PE ratio. The Fed has been fanning a strong recovery from the 2008 global financial crisis, a market system continually manipulated by central banks who, through antics such as cash for clunkers to quantitative easing, designed to delay the necessary restructuring of corporations that are not too big to fail. Listen closely to the key words currently used by all financial media outlets: bubble economy and pyramid economy. Are you investing your hard-earned money into a pyramid? Would you like to know if you're at the top or the bottom of this pyramid? U.S. equity recovery cannot be sustained without the Fed's aggressive support. The effect of the Fed's support is detrimental to our retirees, continues to devalue the U.S. dollar, which has led to waning foreign confidence as to the viability of a sustainable market correction. Last, to better understand the Billionaire Code, let's look at fund manager John Paulson, who in 2011 purchased $157 million worth of JP Morgan when the shares were trading at $28 per share, and in Q4 of last year sold his position in JP Morgan, realizing earnings of several $100 million. We can now see a decline in Morgan's share price of 15%, or more than a 98% uptick in Paulson's favor. Paulson's prophetic trade is directly correlated to Morgan's waning mortgage originations, which were down 68% in Q1 of this year. Remember, Paulson sold short these very same financial institutions pre the subprime meltdown, trades that netted him more than $6 billion in income. I am sure you are seeking the same level of advice. Here at Best FQ, we are providing you with true financial intelligence. To learn the top 3 things you can do to protect your portfolio, please visit bestfq.com and request to be contacted by one of our code specialists. Thank you and have a blessed day.